Imagine waking up one morning in 1931 and realizing everything you thought was safe has vanished. The banks are shut. The markets are frozen. And the entire country is spiraling into chaos. Now fast forward to the 1970s, same feeling, different crises. Your dollars by half of what they did last year. Fast forward again, 2008, 2020. Every generation has lived through a moment where the system suddenly flips upside down. Here's the part almost nobody knows. Through every one of these disasters, a tiny group of people didn't just survive, they came out richer. They all held the exact same three positions. Not guesses, not lucky trades. The same three positions that quietly protected wealth through the Great Depression, through runaway inflation, through the housing crash, and even through the global shutdown. And the craziest part? One man in 1974 discovered this pattern almost by accident. And when he acted on it, what happened next shocked even the economists who were sure he'd get wiped out. So what were these three positions? How did they beat every crisis since 1929? And why do some experts think they'll matter even more in the next downturn? Stay with me to the very end. Because once you see the pattern, you'll never look at markets or your own portfolio the same way again. And if you want more deep financial history breakdowns like this, make sure you subscribe. There's a strange pattern that shows up every time the world faces a major financial collapse. It appeared in 1929 when the stock market imploded. It appeared again in the runaway inflation of the 1970s, in the 2008 financial crisis, and during the global shutdown of 2020, and long before that, it kept showing up in Rome, in medieval Europe, during the French Revolution, and in nearly every empire that ran out of money. The pattern is simple. Most people panic, most assets collapse, and most of the middle class is wiped out. But a tiny group, always a small minority, survives every crisis, every crash, every inflationary meltdown. Not by luck, not by insider information, but because they held the same three positions that history shows repeatedly outperform in every crisis for the last 100 years. These positions aren't glamorous. They don't require predictions. They're not speculative bets. Time after time, they're the reason one group lives through crises stronger, while everyone else loses decades of wealth in a matter of months. To understand why these positions work, and why they might be even more important in 2025, we need to look back, not one decade, but across 100 years of financial destruction and renewal. Let's start in 1929, when the stock market crashed and the Great Depression hit. Stocks fell nearly 90%. Banks collapsed. Unemployment hit 25%, but a small number of families survived, and some even grew their wealth. Why? Because they weren't concentrated in equities. They held what historians call real collateral, assets with scarcity, utility, or income that can't be printed during deflationary collapse. Fast forward to the 1970s, completely different crisis, completely different economy, yet the same pattern. Inflation hit double digits. The dollar lost half its value. Anyone holding cash or bonds was annihilated. But the people who held real assets, hard assets, didn't just survive inflation. They crushed it. Then came 2008. Housing collapsed. Banks imploded. Stock markets cratered. But once again, the same three positions quietly outperformed, the same positions used by wealthy families, sovereign funds, and institutions who understood the historical playbook. And in 2020, when the world shut down overnight, markets crashed, governments printed trillions, and inflation ignited globally. The exact same three positions protected wealth, while everything else turned into chaos. So what are these positions, and why do they always work? No matter what type of crisis hits, whether it's deflation like the 1930s, inflation like the 1970s, debt collapse like 2008, or a global shutdown like 2020. Before I reveal them, you need to understand the core principle behind all financial survival. It's not predicting the future. It's not timing the market. It's understanding how every crisis eventually resolves. Crashes aren't random. They're the result of imbalances. Too much debt, too much leverage, too much speculation. And when the system breaks, governments respond the same way every time. They print money, cut rates, freeze markets, and try to reflate the system. In other words, every crisis begins with deflation, fear, and liquidation. It ends with inflation, money printing, and currency debasement. So the three positions that survive every crisis have to work in both environments: during the initial crash and during the inflationary aftermath. Now you'll begin to see why these positions keep beating every collapse since 1929. Position number 1 survived the 1930s, soared during the 1970s, stayed strong through 2008, and rose again in 2020. Position number 2 protected families in 1929, created fortunes in 2008, thrived during COVID. Position number 3 was the single strongest performer after every inflationary episode of the last century. Let's start with position 1, the one that quietly outperforms in every crisis: productive hard assets, farmland, energy infrastructure, and essential commodities. Assets that produce something regardless of market conditions. In the 1930s, when markets fell 80%, farmland yields kept families alive. In the 1970s, commodities outperformed stocks by more than 400%. In 2008, while real estate collapsed, energy and agriculture recovered first. And in 2022, commodities surged as inflation exploded globally. The reason is simple. When money loses value, real things gain value. And when money gains value during deflationary crashes, productive assets still produce income. It's the only category that works in both collapses and recoveries. Position 2 is a completely different kind of asset, but it also survived every crisis. This is the position almost every wealthy family in history has used. Because it's immune to counterparty risk, self-custodied, and scarce stores of value. In the 1930s, this meant gold. In the 1970s, gold rose 20x as inflation destroyed the dollar. In 2008, when banks were failing, physical gold outperformed the stock market by more than 100%. And in the 2010s and 2020s, Bitcoin emerged as digital scarcity, not replacing gold, but joining it as a parallel store of value for a digital age. Hard, scarce, self-custodied assets protect against the phase after every crisis, the money printing phase, because the final stage of every financial collapse is always currency debasement. Position 3 is the one that almost nobody talks about. But it's the reason institutions and sovereign funds never fully collapse during crises. Cash and short-duration liquidity. In 1929, the people who survived had cash when asset prices fell 80%, and they bought everything. In 2008, the investors who weren't leveraged scooped up assets at generational lows. In 2020, those holding cash were able to deploy when markets were frozen. Cash doesn't outperform long-term. But in the first phase of every crisis, cash is power. Cash is optionality. Cash is the ability to buy what everyone else is forced to sell. These three positions, productive assets, scarce stores of value, and liquidity, are the only portfolio structure that has beaten every crisis for 100 years. What here is the real reason I am telling you this now, because the imbalances in the system today are larger than anything in 1929, larger than the 1970s, larger than 2008, and even larger than the distortions created in 2020. Global debt is now over $300 trillion. U.S. debt alone is $37 trillion. Interest payments are exploding. Housing is unaffordable. Corporate leverage is at record highs. Banks are exposed to commercial real estate collapse. Central banks are trapped. They can't raise rates without crashing the economy. And they can't cut rates without igniting inflation. That means the next crisis, whether it begins in 2025 or 2026, will likely include both phases: deflationary collapse, followed by inflationary rescue. And history says the people who survive are always the ones holding the same three positions. Not all in one. It's not betting on one outcome, but balance between all three. So the question for you is simple. Which side of history do you want to be on when the next cycle begins? Because the people who study financial history aren't scared. They're preparing. Quietly. Calmly. Gradually. While the rest of the world ignores the warnings. If you want to understand these cycles before they hit, if you want to see the patterns forming beneath the headlines, subscribe. Because the next 18 months may become the most important financial period of your lifetime, and the patterns that started in 1929 are repeating again.